Hello, everyone. Hello. This is Alex with Main Street Investing, and let's get down to business. What is stock market and how it works? Stock market is a general term which refers to the collection of multiple exchanges, such as New York Stock Exchange, London Stock Exchange, or NASDAQ, where trading of multiple securities occurs, such as shares of a publicly traded companies, options, or ETFs. The way these securities are traded is by buyer setting a bid price and seller setting an ask price. That's where the law of supply and demand comes into place. And if they're matched, the trade happens. Also, if there is more buyers than the sellers, then the price of the security will go up. Matching buyers and sellers used to be a manual job, but now we have brokerage firms which act as a middleman between buyer and the seller. By the way, I will be making a video about best brokerages and how to create an account. Now, I want to break down stocks, bonds, options, and ETF, since this is what we will be mostly concentrating on here. Stocks, or shares, represent the ownership of a publicly traded company. Think of it as a slice of a pizza. So if you have one share of Apple, you have a claim to its assets and earnings. But there is 16 billion shares of Apple, which means you only own 1/16th of a billion of Apple. In order for shares to be traded on one of these exchanges, a company has to go public. They will file an initial public offering, or IPO, which will allow them to sell some shares to the public. Let's talk about bonds now. You hear these words almost on a daily basis, bonds, but what is bond? Bond is an IOU, or a loan to a borrower. It has an interest rate, and it has a maturity date. If it has a 2% interest rate or yield, you will be paid 2%, usually yearly, and when the maturity date comes, you will get your principal or original amount back. Now, I want to talk about ETF, or exchange traded funds. They have become really popular nowadays because it is an easy way to diversify your portfolio. So how do they work? A manager comes up with a portfolio and allocates a certain percentage to some stocks or bonds or other securities. And when you buy that ETF, you are buying all those underlying securities in one. Also, there is a lot of passive ETFs that track an index, for example, Dow, S&P 500, or NASDAQ. Now, let's talk about options. Option is a contract that lets you buy or sell a security upon agreed price and date. We have two types of options: calls and puts. Call lets you buy securities, and puts let you sell securities. They have a strike price, which means if that stock reaches a strike price, you will be able to buy it or sell it at that price. There is more to it, but options is a really big topic, and I just wanted to give you a general idea about them. It's time to end. Like and subscribe, and hope to see you again.